Even with my kids, same thing when they're looking for.
What up, dude?
Good man, how's it going?
Say that again.
So, what's the word? How's it going?
Oh, good. How about you?
Chilling, man.
Mark's getting on today?
Chilling. I'm not sure. Not sure. I'm just about to share my YouTube audio real quick. Got the live going. I guess we don't really need it. I don't know why I can't find the share audio right now. I think I'm tripping.
Did you click the share button again? You click the share, and then it's on the right. It says options, share sound.
Let's find it. Right, yeah, I'm gonna let the world know we are live and up and at it. I'm gonna spend some time on doing some chart markups. Since we moved through some of my previously marked up zones already.
Yeah.
So over the last couple of days last week and then yesterday morning as well.
Turn down music just a little
Get
bit.
this little started. That's about as low as I can get it.
Good right there. It's perfect.
Just- What's the price at right now? 2360. 2360. I'm gonna get rid of this blue box here.
361. Wow.
Oh, it's all right. Good morning, everybody. Getting this all settled in. 5:14. I'll call this the official start to the live stream. Uh, got Jerry Trades on here with me. Marcus might be hopping on here in a little bit. But back to our regular scheduled programming. Tuesday, 5 a.m. trading. Up and at it every single Tuesday, Wednesday, Thursday. Back for another one here. Today I want to get into a lot of just chart markups. I'm gonna spend, probably the first 45 minutes to an hour, maybe not that long, 45 minutes doing some chart markups, and analyzing some potential areas I can see price moving to, referencing both liquidity and areas of inefficient price. So I'm going to kind of work through that and then kind of do a markup masterclass, if you will. Just kind of go about our method of marking this chart up. On XAUSD, you're going to stay here. Actually, I'm going to move to my side-by-side. Side-by-side on there. Gotta move me and Jerry's face over a bit. All right, here we are on the side by side. XAUSD to my left, US dollar to my right. It was beautiful. It was really nice to see this area get filled up here. This is a 4-hour decision making zone. In the name of my what we call top-down analysis, I'm gonna start up at my higher time frames and then work my way downwards. Where the heck are the candlesticks? There you go. I'm gonna start on my daily, work my way through the 4-hour, 1-hour, and then peak at that 15 and 5 as well to my smaller time frames. But here, let's find some inefficient price. delete some of these old markups. Oops. Alright, got one already. I'm looking at an inefficient price. Call it right there. And I'll articulate the level as well, just in case you can't quite see. I'm looking at area of inefficient price on my daily time frame from 23:37 to 23:48. Just call it even numbers. Just understanding the range, I think, is the important part there. What is this? Oh my days, my trading view does not want to function properly. There we go. And as always, I like to do just a little quick markup on this area of inefficient price, just so I know where I got it from. I'm looking at I'll do D for daily area. Actually, I could do FVG for fair value cap. So that's one in the general vicinity of where price is at. Here I'm looking for areas in price that price is most likely to move to. So this kind of makes sense for me to find those areas that are closest to where live price is. We have some good liquidity marked out here. I'm gonna redo it just for the sake of call. It's easy enough. But seeing some good areas of liquidity that we can mark up here. I'm blowing up that area. So liquidity is found at the highs and the lows. What's important for us to understand is what liquidity is most likely to be swept up. Because liquidity lies everywhere. And understanding that liquidity lies at the highs and lows makes it easy to recognize. It's just on us as traders, as developing traders, to be able to understand which most likely to get swept up once again. Yeah, I like these areas marked up here. And then kind of fine tune it as I move down these time frames. You notice I moved down to my 4-hour time frame. Jerry, you mark up liquidity. You mark up. What do you mark up when you mark up your chart?
I strictly mark up my
What does yours
decision making.
consist of?
I strictly mark up my decision making zones just from our top down analysis from my daily, my 4-hour, my 1 hour. I mean that's really it. After I do those three, I most of the time stick on my 1 minute chart.
That really just speaks to we can really make this this scale, especially just in trading view particularly. We really have a lot of autonomy in how we can go about marking up our charts, whatever we find useful, whatever methods is consistent for us. Like this area as well, another area of inefficient price. Do down a 4 hour fair value gap. Recognize the 4 hour gap in price from about 23.34, 23.42. That's an area again relatively close to where live price is at now. Um, therefore, that'll be a level, an area that I will look for price to sweep up here as I continue my top down analysis. And of course, at this point, I'm merely marking up these areas. I haven't um, analyzed any volume or really any of the market conditions over since market opened on Sunday. So I'll get to that, but here's strictly just finding these areas of inefficient price, marking up these levels of liquidity, and then I can progress on from there. It's really not that much, areas of inefficient price. Crazy how precise this is. Move down to my 1 hour, continuing to hunt these areas. Like I said, the liquidity is easy to see. The liquidity is at the highs and the lows. If we understand, what we call decision-making zones, or our levels of supply and demand, support and resistance, are really the same term. We can recognize the stronger liquidity, the liquidity that has a little bit more value, if you will. Like this liquidity here. I'd love to see that get swept up along with this.
I'm gonna log in my trades from last week. Or seeing how much I profited last week.
Remove. And there's some little areas of inefficient price in here. Yeah, I'm gonna throw a box down there actually. Yeah. I'm gonna make kind of expansive just to honor both those candles. All right, yeah, that's pretty much a lot of it. I'm over here trying to find more of these areas, but if they're not there, they're not there. I was able to throw down three different areas of inefficient price. Um, I do want to look on the bullish side though. I'm gonna go back up to my daily, and I'm gonna look at what's above me. There we are. There we are. That's what I missed here. It's like I know I'm missing something. Bam. I like to do, take care of the bearish and the bullish side. Um, so wherever way the market goes, as we know, we don't control the market. There's a lot of factors that control the market. We're not one of them. We are players, and we have the ability to profit off of these moves. But I'm just gonna type this in. FG. But I just want to be prepared whether the market goes bullish or bearish. We'll do our best to predict, if you will, which way it's gonna go. Of course, utilizing our tools, but because of the randomness, um, and just to be thorough, I do want to make sure I have my areas marked up on my bullish and bear side with respect to where I'm at in live price.
4 for 4 last
So
week.
this area was
Go ahead.
this area was created May 21st. Just for you said 4 for 4, 4 for 5.
4 for 4, profit 39 pips, up 5.1% on my account. Total, I'm up about 36% on my account, I believe, over the past 3 weeks now.
Not bad, not bad at all. Not bad at all. It's good work. All right, yeah, that'll be a lot of it for my areas of inefficient price and liquidity. I'll continue to talk about those topics. We'll continue to talk about those, of course. Two massive aspects. The way I execute my trades at the very least. And then move my 15, my 5, and my 1, and I'm gonna see. And here's where I start to determine momentum, volume, strength, and just try and get a read on what's going on in the market at the moment. Looks like we're held up good by 4-hour decision-making zone. This is an excellent time to bring out our Forex factory. Let's see what news we got. Okay. I'm looking at my Forex factory here. 7 a.m. Fed Chair Powell. He's testifies. I think that's a new phraseology, um, for me at least. That's a red folder. Fed Powell testifying. Red folder 7 a.m. So here in about hour 25. Then got another orange folder drops in right at 7 as well alongside it. Treasury Sec Yellen speaks. What a name, Yellen. And looking through the rest of this morning session, doesn't look like we'll run into anything between now and 7:30 when the call ends. FOMC member Bowman speaking at 10:30 today. That could be something to pay attention to. I'll just be interested to see how that affects currency, whether it's good for currency or bad for currency. But yeah, keep my eye out on those two 7 a.m. folders, and we'll look to see how they, how they impact our currency, our U.S. dollar. And so to take it to the next level, in a sense, this week I'm gonna start marking up my DXY as well. Nothing too crazy, but I do, for the same reason that I mark up my XAU USD chart. They function the same. It's truly, really a system of equations, a systematic. There's a systematic way that these candles move. And understanding liquidity, understanding areas of inefficient price. Only just understanding those two things, you're able to be keen to just the innate movement of the market, just the general functioning of the market, where it moves, the areas it moves to, when it moves to them. But so for the same reason I did that on my XAU USD, I can do that on the dollar as well. So I'm gonna take some time and do just a little bit of top-down analysis and just find some of these areas of, one, liquidity, and two, areas of inefficient price. Excuse me. See, this area is glaring in my face. That bad boy out. So I was able to find two on the bullish side on my 4 hour time frame on my DXY, two areas of inefficient price. Um, I can strain too hard. We're gonna move to the bear side and see what's sitting down there for me on the bear side. I'm on the dollar as far as inefficient price goes. I'm getting close to um, really starting to read the momentum and volume, and starting to understand where some trade positions could come into play here through this morning session. Again, my first day on the charts this week, I want to be as thorough as I can, as far as marking up my chart goes, because this is going to last me, maybe past this week. Might let these markups will last me, for the next 2-3 weeks. So, to me, it's worth the investment in time. Um, to really just go through my XAUSD, as well as my dollar. Off the call, this is a process I'll do on my other currencies that I'll trade. But just for the sake of this morning's call, I will not be doing that right now. Looking for areas of inefficient price on the bearish side on the DXY. Not really seeing too much. It looks looking pretty balanced at the moment, actually. But that just means we have to look a little bit further back, because we know they're there. We understand they're there, scattered around amongst the vast sea of all these candles on all these time frames. I got daily, good bearish side area of inefficient price. Man, this dollar looks pretty balanced, and again, once you're able to see these areas of inefficient price, it's truly one of the most spectacular things that you can lay your eyes on, honestly. With a thing, and this thing being the market, with how random it seems, with how up and down it seems, recognizing the way it balances itself out and the way it progresses through time, continually balancing itself out. It's a never-ending cycle of sweeping liquidity and balancing out areas of inefficient price that it's left. So it's truly spectacular, just as I move through these candles, scroll through these candles, seeing all these areas be filled up like, so precisely and so exact. It's truly a phenomenal sight. Squeeze down in here. Yeah, I mean, these really, I got down 3 areas, 2 on the bullish side, 1 on the bear side. So I think I did a good wrap on where the dollar's at the moment. I'm gonna lock that back down to the 5 minutes, and start looking at some trade setups here. But Jerry, I'm gonna run to the restroom real quick, and then we'll get hammering in, try and set up some positions this morning.
Well, yeah, so oh.
right, enough diddling around. Let's take some trades, man. Let's get in here. See
Could
what
have
we
some
can
sales
do.
coming
What'd you
in.
say?
I said could have some sales coming in. You have a 4 hour decision making zone on right where we're at.
Yeah, I got some inefficient price line there below. Let's see, strong area though. But yeah, some shorts here could be coming in. Further. Where is my text on this? And so I usually sit on my 5 minute time frame. Just when I'm sitting here reviewing the market, looking for setups. Um, we'll utilize my 1 minute, for when I'm executing my trades. About to push that buy or sell button, just to really find that best point of entry. But I really do my best to combine the 15, the 5 minute, and the 1 minute, and assure that they're telling me the same story anytime I'm executing a trade. And by that meaning, if I'm taking a sell, I want to have good sell structure or good sell setup on all three of those time frames: my 1 hour, my 1 minute, my 5 minute, and my 15 minute. I want them all to be telling me the same story. And then, of course, utilizing our DXY, utilizing our dollar to help predict movement. Yeah, seemingly not a lot of movement this morning. Really just kind of accumulating along this 4 hour decision-making zone I have here. Got a little bit bullish yesterday, nothing crazy. Got up to about 2370, sitting right around 2360 right now. So again, yeah, nothing crazy, nothing spectacular. I'm looking to this fetch pal folder a little bit. Let's see what Fed Chair Pal is up to today. Description: due to testify about semi-annual monetary policy reports before the Senate Banking Committee in DC. More hawkish than expected is good for currency. I'm gonna have to remind myself what hawkish means. I haven't seen that much. I feel like every time I do see it, I have to look it up. So I feel like I almost have it ingrained, but we're getting there. It's why traders care about this folder. As head of the central bank, which controls short-term interest rates, he has more influence over the nation's currency value than any other person. Traders scrutinize his public engagements as they're often used to drop subtle clues regarding future monetary policy. And there you have it. Fed Chair Powell. Shout out Powell, man, as we say. Hawkish. Having a militant attitude or that. What is hawkish in the stock market? Hawks vote for tighter monetary policy, meaning higher interest rates, with the aim of keeping inflation in check. This is a good one for Chat GPT. So very subtle, very slow movements from our dollar and XAUUSD, uh, which gives us plenty of time to do a little bit of research here, and grant some of these principles. And this is all the journey of trading is. This is what my trading sessions look like. Got the chart up in front of me. Understand my levels where price can move to. If I see some action happening, I'm gonna get down in there, hyper focused on the market, hyper focused on the charts, and look to execute timely and accurate trade positions. But over the course of 2.5 hours, on average, I'd say we're taking 1.8 trades a day. If I had to put an average on it, maybe 2 trades a day. So there's so much time during our trade sessions just to get good research in, especially if we're busy during the rest of our days. We got other things going on. Maximizing what you get out of these trading sessions is just super important for our development. Here. So I'm trying to just make sense of this verbiage here on Fork Factor. Here I expanded the Fed Chair Powell folder, the 7 a.m. folder for today. I've expanded it, and I'm looking under usual effect, where it says more hawkish than expected is good for currency. And so that's what I'm really trying to break down. Like I said, I've looked this up, and anytime I see it, I feel like I don't see it that often, that phrase, hawkish. But here, I'm gonna get this ingrained in my brain here. AI, particularly for financial market research, just because there's so much this information out there. It's never-ending information. It seems like you using ChatGPT or any other form of AI to answer some of these financial market questions is very, very efficient, and you get good information, really good information. I'm gonna work through these entries here. So I wrote down, or I'm really just typed in the prompt, what does hawkish mean in relation to the financial markets? Because as in the context of financial markets, hawkish refers to a stance taken by central banks or policymakers that emphasizes controlling inflation as a primary economic concern. Interesting. A hawkish stance generally involves 1, tightening monetary policy, 2, reducing stimulus, and 3, emphasizing price stability. Investors and market participants closely monitor statements and actions from central banks to gauge whether their stance is dovish. Dovish meaning emphasizing economic growth and employment, or hawkish. Okay, I really like that disparity there. It provided the opposite term for us, dovish. This is my first run-in with that term, dovish. That's interesting. I'm gonna reread that sentence for my sake. Investors and market participants closely monitor statements and actions from central banks to gauge whether their stance is dovish or emphasizing economic growth and employment, or hawkish, which emphasizes inflation control. A hawkish shift in policy can impact financial markets by influencing interest rates, yada, yada, yada. When Forex Factor or any financial news outlet mentions that a development is more hawkish than expected, it's good for currency. It refers to a situation where central bank or monetary authority adopts a stance that is more aggressive or strict in controlling inflation than what market participants had anticipated. Okay, so hawkish is really just referring to inflation. And the Fed's stance on inflation. That's very interesting. But yeah, highly recommend, just pull up the Chat GPT, work through some prompts. You can ask. It's beautiful because you don't have to ask the most intuitive questions ever. They can be the most simple questions, but you just kind of develop through the chats, and the AI kind of, it doesn't learn per se, but it really gears its responses to help you understand whatever it is you're looking to understand. So it's a fantastic tool to streamline education for us in this space.
Not a lot of news today.
No, not a lot of news at all.
So do we have something throughout the week? Barely any at tomorrow. We have one red folder tomorrow at 7. Thursday a lot.
Yeah, but walk us through Thursday. What we got Thursday?
Kind of a lot. Just one time at 5:30 in the morning, 4 red folders. And that's it. It looked like a lot when I clicked on it, but just one time. A lot of news at that time.
I really like when the news comes nice and early like that. I love the 5:30 news.
I did too. Gets the market moving quick.
I got PMI on Friday. Yeah, big news to close out the week, that's for sure. But Powell also testifies tomorrow. That'll be interesting to see if anything changes from his testification. I wonder if that's a word. There we go. Look at it. So testification is not a commonly recognized word in standard English. The common term would be testimony, and indeed it is. Indeed it is. That's what I was looking for, a testimony. So it'll be interesting to see if Fed Powell's testimony changes from today, going forward to tomorrow. That'll definitely be something to pay attention to. Price still accumulating along that 4-hour decision-making zone. Of course, seeing our dollar relate to XAUUSD and its analogous yet inverse movement. That's always a good confirmation for us to see. looking at my MACD. If you look at the bottom of my screen here, and to the left or right, this tool, our MACD, what we could reference to as our Bloom 3 as well. You know, if you look along this white midline, you see the light blue, dark blue, lighter red, darker red bars on that white midline on our MACD. That's our volume indicator. It's gonna tell us the volume that's in the market. And as you can see, some good buyers volume coming in at the moment. Again, not that much volume in the market right now. I would like to see that change as we continue to press on here. Flat cloud means consolidation most of the time, if not all the time. Whenever this cloud's nice and flat, I'm gonna sit on my hands and wait for some good volume to move that cloud.
Run to the restroom to get some coffee going. Be right back.
Sounds good. Gonna pull my baby piss, not getting a lot of movement, not seeing a lot of volume coming through my XAUSD pair. Of course, there's volume in there. When I say that, I'm not saying that there's no volume in the market, because there certainly is, especially seeing some good volume coming now. But here, just waiting for a significant move. I'm gonna utilize my baby pips resource. This resource here is a fantastic tool, one of my favorite tools, because it gives us insight into currency strength, pair strength. See over to the right, you get a good market snapshot, currency strength, currency heat map. You just get good insight into what currencies are strong right now. You see JPY looking strong to the bear side, GBP leading the way on the bullish side there. It makes sense why GBP JPY is our top earner this morning, our top gainer. Anything involving JPY at the moment, actually. So in that light, let's take a peek at what my JPY pair looks like. Is looking like this DJPY. I think this is it right here. And look at this here. I have both my USD JPY and my DXY to my right. Of course, that hasn't changed. Look at just the similarity in structure. Here I'm just getting at why we utilize the US dollar, why we utilize this side by side, why it's important to us. Look at the similarities in structure, right? Speaking to the strength of the dollar, it really just guides these pairs. Ooh. A random spike up there. You can see my blue boxes here. Um, if you missed the beginning of the call, these blue boxes are my areas of inefficient price. Um, very simply put, these are areas in which I'll look for price to move completely through these areas. Given we have good volume, given we have good strength coming through the market. But those are two areas that I'd like to see price move to as we progress on. Whenever price is just accumulating like this, we have to stay patient and sit on our hands, not force anything. Sure, we can make some, we can get in there and play, but why? Why? I'm certainly in a mind frame, in a frame of mind where I want to capitalize on these big movements. Wait on these big movements. On gold, I'm looking for anywhere between 50 and 100 pips on my entries. On other pairs, I look for about 25 to 50, just because of the volume disparity between XAU USD and other currency pairs. You see that buyer's volume kicking in, getting that MACD back to neutral, back close to that white midline. Looks like that dollar wants to move bearish here, so I'm looking to see if we can get some good longs to set up for us on XAU USD. And so a couple things I'm looking forward to this week. Looking to focus on this week. Where's my little notebook? I'm gonna annotate as I talk on this.
Well, buys coming in, maybe.
Possibly. Dollar's starting to move a little bearish for us, which is nice. Some longs could set up nice for us here. One of my main focuses this week is going to be funding my live account, and then calculating my initial risk, so my initial lot size on that live account. I'll take care of that tomorrow. Won't be on the call tomorrow morning as I'm closing bar tonight. So it'll be a late night for me. So the early morning will be tough. But tomorrow I'm going to take care of that live account, and then moving on to Thursday and continuing on. And going to be trading that live account. Putting in a lot of time, back testing, doing demo work. And yeah, it's time to get that live account going, and start to work towards funding that live as much as I can. We spend a lot of time, figuring out what worst case scenario looks like for any individual trade position, and just in general, understanding your risk, and preparing. That's what gives you the confidence to execute, and be decisive in the market. So yeah, in the name of preparation and doing the things that we need to do to be successful. Really excited to get that live account going, in a super confident headspace. When it comes to this, our tools, our development is really starting to pay off. Yeah, so other than logging my trades, and I mentioned it last week when I was on the call, either Tuesday or Thursday, my protocol is going to be to log all my trades during the session on my trading view. So Markup, use my long and short position tool, do a little text annotation directly on my trading view, and then post trading session, transfer those notes to my Excel document, to my trade log. We'll see. I know I mentioned some longs potentially coming in. Looking at my Bloom 3 or my MACD here, that buyer's volume is getting to its peak already. Making me feel like we're gonna just stay in this consolidation area. But we'll see. We'll see how this momentum carries through over the next hour or so.
Trading on demo right now, right?
Yes.
How's that account looking like? How long have you been on it?
It's good. I've been on this demo for shoot, probably a little over a month. Probably a little over a month. Started with 300 in there. It's close to about 4 right now. It's at like 390. Let's take a peek.
Awesome.
Let me take a peek here. Started the demo at 300, currently sitting at 388.95, and roughly about a month of trading there. And we talked about this, Jerry, on the last podcast. And anybody watching this live stream or this live stream recording, highly recommend you tap into our last CEO session. We have another one releasing this week. We'll continue providing a lot of just trading insight, our perspective on trading, our journey, our experiences. Yeah, highly recommend going to listen to those episodes. But yeah, and this is what I was getting to, Jared. What we talked about on the podcast is treating the demo, like it's your live. Treating your demo as making your demo as real as possible. What have kind of been? How have you gone about your demo work through your trading career? How different does trading a demo feel or work for you 6-8 months ago versus now? Is it much different for you?
It's not any different, but the way I approached it is I wouldn't take it seriously. And the way it's different is live money. You make one bad trade and you lose the money. With a demo, you take a bad trade and you just lose nothing. You just lose your fake money and you can just restart it. There's no, there's no, you don't lose anything for the lack of discipline, and taking bad trades or not following your rules. That's what I did for a while when I was on my demo in the beginning was, just take a trade here or there because I could, rather than, treating it like a real live account. And that's what we talked about on the podcast was just taking that demo and being as disciplined as possible, as if you were trading with your real 300 or 3,000 or $30,000. So that when you do go do that, you just translate the exact rules and disciplines you've been following over the live account. That's the purpose of a demo. Find kind of your rhythm, I guess, or find consistencies. And you can only do that if you're treating that like a real account. And that's exactly what I've been doing the past 3 weeks. Is just treating as if I had a live $3,000 in my account and taking everything very serious, not taking trades near decision-making zones or near news, or if not everything's, I don't want to say perfect, but as close to perfect as possible as far as my confirmations. If I don't love it, I'm not going to enter it. And that's how I would treat a live account. So that's what I've been doing lately. And it works.
Sure. Yeah, it's money. It's money. And that's really what we're trying to, hit home with these demo accounts, right? It's making the demo conditions as real and conducive to live trading as possible, or else the reps are fleeing, or else the reps aren't good reps. I wouldn't call them good reps if we're not taking those positions in a way. I mean, maybe to be completely candid, like on your demo, have the autonomy to try new things out, but always have, clear intentions and understand what you're trying to get out of any individual trade position or at any trade session, any whole session. If you want to approach what's a demo session where you want to try new things out, excuse me, then you have the autonomy to do so. As Jerry said, demo accounts allow us to trade and not have any of our capital at risk. So it's an excellent way for us to develop our trade plan, add new things, take things away, really just fine tune our methods of executing. As CEO Marcus high steps into the live call this morning. Yes, looking at 625, got the Fed paired shout.
Fed paired shout.
I've butchered that probably 3 times trying to say that. Fed Chair Powell's testimony coming in about 35 minutes.
Can you set up our camera?
Along with another US dollar orange folder at 7, Treasury Sec Yellen speaking.
Anybody take any positions this morning?
Not yet.
Oh, no positions. Haven't loved anything. Really subtle movement from the dollar. Just getting some good buyers volume to come into our XT USD pair right now. But not getting much trail from the dollar. I want to see how this cloud shapes up as we continue to move bullish. Possibly cloud's been flat for the better part of this entire call. Span A, Span B coming together now. Looking at my 5-minute on XAUSD. So I'm gonna run to the restroom real quick. I think I'm gonna get some coffee going as well. I'll be back in 3 minutes.
Bro.
But
Yeah, I need to get my coffee for sure right now.
BHM.
What was the date yesterday? 7/8.
You work today, Mark?
No,
Day off. I get to work today and tomorrow.
Hmm. Can you bring me a chair? Read the clock creamer. Did you heat up the creamer?
Mark, you been on the charts at all this week? Here the dollar goes. Bearish movement coming in from the dollar. We're starting to see that bullish cloud come through on my 5-minute on XAUSD. Yeah, that volume is peaked out. I'd like to see some of that volume retrace back down and then continue to push.
Can't do these things. Plugging headphones. These shit suck.
That's a little gaming headset.
You guys hear me?
I can hear you.
There we go. How you feel about the market this morning? What you thinking this morning?
Yeah, market's been pretty balanced. You know, it did a good job balancing itself out, you know, after it slipped through that liquidity end of last week, and Monday as well. Market opened this week, so market's pretty balanced. Um, I have areas of inefficient price lying on the bullish side and bearish side that I'll look for price to, kind of move through. But yeah, I've gotten just a read on accumulation this morning. Clouds remain flat. Dollar has remained flat up until this point. I'm starting to get some good movement here, but potential for liquidity sweep right about 2370. Pushing on that area now. Nothing major, but
Yeah, it had that good drop yesterday, huh?
yeah,
Good clean drop yesterday.
super clean.
I actually considered a buy a second ago after we got that clean angle. Dollar started to push down some more.
I like that play. Like that play. Yeah, I like us to get through that 2370 marker.
Yeah, I do like that as well. I think I have that on my own. 270. Yeah, there's still a little bit of imbalance in there as well.
Did you guys enter it all? I think Marcus, you did.
Yeah,
70.
I entered
Just caught that
23.
little drop down there.
I entered at 2365, 68. Let's see what happens here.
I got in at 2364.79.
Yeah, looking at the 5 minute, I'll look to take this to honestly around this 2370, 74 range.
Mm-hmm.
Just get up there between those. Looking on the 1 hour, just that most recent kind of accumulation period, right at about Monday. Just before we got into the big drop yesterday.
How's the AC? AC fix it?
AC is somewhat fixed. It's actually like cooling, but it's still like not as bad as it was. Now we just gotta get them to come out and fix. Just because like when it gets down to the temperature that we set it at, it just keeps running.
Mm-hmm.
It doesn't stop at 77. If it gets there, it just keeps running. But at least it's in some cool air.
Yeah.
I tell you what, that's why I actually slept in a little bit today, being in my bed again. I was like,
yeah.
But that shit was terrible. It was like because I would come home and get ready for work, and I'm sweating as I'm getting ready for work, putting on my shirt and tie. It's 96 degrees inside. I'm like,
terrible. Atrocious, man.
Really
so
makes you
hot.
appreciate something like AC though, bro. It's like, what the heck? Being in Arizona, kind of something you just look over, like, take for granted.
It's supposed to cool off a little bit next week. This week was a hot week, bro. Last week was a hot week. This week is a hot week.
Well, I pocket over here. Yeah, it was a hot week this week. Even late too. Like I feel like we could get
Yes,
into
sir.
some
Yes.
cool weather like late at night. I'm pretty sure this Fed Powell. I'm probably gonna watch that as well. But this Fed Powell testifies. It's funny because it is exactly what it sounds like. Fed Powell testifies. Yes, he testifies on behalf of the federal the FOMC members and their stance on political views. So one thing that's important for the FOMC is to emphasize their separation from political parties, because they don't want the lack of change in interest rates or the change in interest rates, them making that move, be correlated to any political party and any type of decision those political those political figures talk about, the changes that they're going to bring. You know what I'm saying? So they want to make sure there's no that is part of why this Fed Powell testifies is going on. The other side of it, when I was just looking at it, I was reading an article last night. It was from BNN Bloomberg.ca. And then the other part of it was him testifying on behalf of why they will not. So something I didn't know, this is the highest inflation has been, or the highest the rates has been in like 2 decades. And he had said back in June that they were not going to touch the interest rates until they got further confirmation they were going to move towards that 2% inflation goal. So he's kind of just talking about that and backing that statement again. So I want to see exactly what happens to that. What happens to the market after that speech comes out?
As-tu accédé à un poste? As-tu accédé à un poste? As-tu accédé à un poste? As-tu accédé à un poste?
Damn, so reading this little excerpt, right? This little paragraph sentence right here. It says the labor market, however, is also cooling, and some Fed officials are beginning to warn about the risks of further slowing. June job gains, while still solid, were concentrated in healthcare and government, and prior months were revised lower. The unemployment rate climbed to a 4.1%, the highest since late 2021. Man, so while the interpretation that I personally get from how Fed Powell speaks about the economy, while it talks kind of bullish about it, data shows that it is not bullish behind the scenes. I guess is kind of how I'm looking at it. Hearing the unemployment rate, when he actually talks about the labor market being so strong, the unemployment rate being at the highest it's been since 2021, it said. That's interesting, actually. I'm still in my position, by the way.
Yeah, early this morning, I went into the term hawkish on Fed Powell's folder in Forex Factory. It says more hawkish than expected is good for currency. Um, so I went through, just did a little quick chat GBT insight into what hawkish means, and got some good information regarding that. Um, hawkish it's really just referring to exactly what you've been saying, Marcus. It refers to a stance taken by central banks or policy makers that emphasizes controlling inflation as a primary economic concern.
Mm.
A hawkish stance involves tightening monetary policy, reducing stimulus, and emphasizing price stability. I thought that was interesting. But what was also interesting is it gave me the opposite term to hawkish, which is dovish. And that was the first time I had heard that term. Where did I put that? Dovish. And so it says investors and market participants closely monitor statements and actions from central banks to gauge whether their stance is dovish, which means emphasizing economic growth and employment, or hawkish, which is emphasizing inflation control.
Yeah, last part again, dovish, emphasizing growth and employment.
Economic growth and employment, yeah. Or hawkish, which is emphasizing inflation control.
That's interesting. I never knew that those terms meant that. I thought it literally always meant either hawkish was like a hawk or in the sky going bullish, or dovish and diving for the bearish. Hawkish, focused on inflation, right?
Well, but I mean, it's essentially so, right? Because, you know, if hawkish means good for currency, bullish.
Yeah.
So I think we speak the same language in saying that.
But it's good to know which side underlines which, because it sounds like more hawkish is you're going to hear strong focuses on inflation specifically. So it's folders like the GDP and the CPIs and the PPIs that we're focused on. But then if it's dovish and they're focused on just economic growth and employment, then, you know, we're going to be focused more on those employment folders, those ones that contribute to the labor market. So that's actually super interesting. And it was interesting that you said investors and who watches that closely? Policymakers?
Yes. It's a stance that central banks or policymakers make.
Interesting.
Okay. I was curious when Fed Chair Powell started his tenure in his seat. So Jerome Powell started his tenure as a chair of the Federal Reserve February 5th, 2018. So he's been there for a while. He succeeded Janet Yellen. And that name should sound familiar because Yellen is now the Treasury Sec. It seems like, just looking at U.S. Treasury Secretary Janet Yellen, who was the previous chair of the Federal Reserve. Interesting.
Interesting. So the person that's speaking today, that's for the Treasury, he was the previous Fed member.
Yeah, and it's a lady, Janet Yellen. Jerome Powell was initially appointed to the Federal Reserve Board of Governors by President Obama and was later nominated as chair by President Trump.
Interesting. Testing. Yeah. So that, I didn't know, that's probably what they're talking about in terms of staying away from political views. If Trump is appointed Powell, then of course Powell could potentially want to influence rates based on what Trump wants to do for the economy. So I can actually It's actually starting to piece together for me and just understanding. Stop, Rocket, and just understanding how the election actually affects currency. I couldn't really understand why it would, but it's starting to actually make a lot more sense.
We got news in 10 minutes, 9 minutes.
Yeah, that's this folder. I'm gonna look it up. Actually, I want to watch it. I actually took a position last night. It was about a 30 pip movement. Not a 30 pip movement, but it was probably like what was my risk to reward? It's probably like a 3 to 1, 2.5 to 1, and it literally missed my take profit by, let's see how much. Of course, I didn't close my trade out last night, but it makes my take profit 255.39. Missed my take profit by probably like 8 pips. So instead of me getting I got like 20 pips this morning, left about 60 on the table from my stop loss not hitting last night. Fed Pal testifies live. CBS News. For those of you who want to check it out, CBS News is we'll have the speech live, going live in 6 minutes. The headline for this that CBN News has is Fed Powell is testifying before the Senate Bank, Housing, and Urban Affairs Committee on the Monetary Policy Report, which details the state of the economy as inflation remains above the 2% target. These speeches are really, really important for me as I've developed as a trader to understand, just because as I look and as I continue to think about my specific trading hours and whatnot, I'm going to trade during the news. Like, it's inevitable at this point. These are the hours I like to trade. This is the market that I like to trade during. So literally every time I get on the market, I'm going to have to worry about news. Well, not worry about it, but consider it. And then, know how to execute off of it. And so these next two folders, these Tuesday and Wednesday with Fed Chair Powell, I think just gives us a little bit more insight to how we can project CPI on Thursday, PPI on Friday, just are really heavy folders going forward, and just how we can see those influencing the market. Of course, we can't predict how they will influence the market, but we can project and observe the potential areas that price could travel based on imbalance. Where does imbalance lie? Where does liquidity lie? We can mark up our DXY chart. I'm really, really starting to enjoy marking up my DXY because it provides it's just more insight. Like, thinking about when we enter on our pairs, like it gives me comfort knowing that I know where price could potentially go. That's kind of funny. I'm saying I know where price could potentially go. That's like a contradiction. But when I have it on the DXY, it's the same thing. Just knowing just having an idea of where the DXY could potentially travel gives greater insight to my entries. And just being able to have my decision-making zones marked up and imbalance marked up also allows me to understand what could happen on some of these news folders because of where we are at in current areas already. Um, so yeah, Rocket.
Yeah, I'm reading a little bit on Yellen's testimony as well. Kind of interesting here. Yellen will be asked about progress in reforming the International Monetary Fund. Oh my goodness, and I lost my note. With the International Monetary Fund, I just did a little, just put a little prompt through as far as what the IMF is. Hold on, stand by.
It's adios, mother. Never mind. different first letter. Hungry practice.
Here we go. The International Monetary Fund provides financial assistance to member countries facing economic difficulties. This aid typically comes in forms of loans, financial programs designed to help stabilize economies, restore growth, and reduce poverty.
I'm sorry, can you repeat that first part?
So the International Monetary Fund provides financial assistance to member countries facing economic difficulties. So it's almost it's essentially like a relief fund, and I'm guessing it's provided by the U.S. government to various countries. So Yellen will be asked about progress in reforming the International Monetary Fund, the compliance of countries that have received IMF aid, and the status of international anti-money laundering and counter-terrorist financing.
If you don't get away from her,
keep in mind that lawmakers can and do ask questions that are not related to the hearing. One topic of interest to market participants is the plan for the Treasury General Account, whose use has helped to offset the impact of the Fed's rolling off its balance sheet. Interesting.
That is interesting, because that gets into why does war impact the market? Thinking about, I want to know who the member countries are, the specific countries that we do provide funding towards, because that actually, once again, starting to piece together why all of this stuff is linked to one another. I'm still in my position right now, moving closer and closer to that 2070, 2270 or 2370 liquidity. News in about 50 seconds. I'm gonna go ahead and pull up the speech on my end. Look, you are getting really, really too close to her. Okay. Hey, can you relax, please? Okay, here.
I mean, I'm gonna take a full close on my position just before this news hits. Yeah, that's just me. I know, Marcus, you're staying in your position. I closed at. Oh man, I closed at right around 25 pips. So again, I mentioned earlier on the call, I'm really looking for that 50 to 100, on XAUSD. As news hits here and continues to move through the roof. Look at that. Definitely push through that 2070 mark there.
Yeah, liquidity gets up there. Yeah, I'm gonna go ahead and close this one just because we're looking a
Yeah,
little
fuck.
too.
I should have. That's interesting. I'm gonna write that down. Staying patient through that potential liquidity sweep there. I think I could have been able to. I should have read that better in closing beforehand, given that they're speeches instead of something like PMI or CPI. Liquidity sweep like right there is felt eminent. Like that.
Yeah, I got out. I didn't really get out with much profit at all. I could have took at the top, but I wanted to see if it would have kept going. But I also knew that I was exposed to potential correction, and just the more I kept seeing that sporadicism, is that a word? From that last candle, losing buyer's volume on the 5-minute gold chart, gaining buyer's volume on the 5-minute dollar chart. So I'm just gonna sit on my hands for a little bit until this speech comes out. If it'll actually show me, I'm trying to watch it here. It'll be on right now. GUAUD, DBP, USD, AUD, USB, both moving bearish as well. All leaving, just looking at my chart, similar candles as this gold, candle, kind of this doji-like candle, with a lot of buy side liquidity. Let's see what happens during this speech. Come here, precious. Come here. Come here. Come here. Come here. Come here. Blah. Here.
Members will have 5 legislative days within which to submit extraneous materials.
Strong buyer's volume coming in, right? Or buyer's movement coming in from the dollar right now.
And also Intel shares, they are rising up 0.2%. It'll extend gains to a 5th consecutive session if this keeps up. And also Nikola, let me do those shares right now. The electric truck maker up 0.6%. Alternative energy truck maker, I should say. Like 72 of its Class 8 hydrogen fuel cell trucks.
I'm entering myself in a sell position right here. I'm looking to capitalize on some of this initial movement from the dollar here.
Overall, the S&P 500 up 14 points. That's up 0.25%. Record there, 55.86. Dow down 141 points. Nasdaq 100 is 83 points higher. That is up 0.4%. We'll check the markets view for a little long. Right here on Work Radio. I'm John Tucker. I guess it means there's more interest in their hydrogen fuel cell trucks.
Hey, I'll be right back. I'm gonna listen to this speech.
Yep.
No, I didn't even know.
Knows the things.
I'll keep pushing down from me. Utilizing my dollar here. Reading the fresh buyers volume coming in for my dollar. Sellers volume coming in on my XAUSD pair. Trade moving in my direction. Sitting at right at about 40 pips right now. Nice took full close right there.
How much you profit?
Close position, I'm looking at 70 pips there, just under $14. Good read from the dollar there. We'll see if the XEUSD wants to continue to push out of this zone, continue bearish outside of this 4-hour decision-making zone that I have here. I want to take a peek to see how some of the other pairs reacted, because I'm sure they had just as much of a dramatic reaction as XEUSD did, of course. I want to see which ones were playable. Here comes a correction from the dollar off of that news movement.
I took a buy towards the very bottom of that when it hit that. You have a 4-hour DMZ on my 1 hour, but same thing.
I select the play.
Today is brought to you by Interactive Brokers Bond Marketplace. Access their vast selection of over 1 million global fixed income securities with no markups or built-in spreads and low, transparent commissions. Learn more at ibkr.com/bonds. I see some, they are active in the Senate in that Banking, Housing, and Urban Affairs Committee, and we'll go to that in just moments when Fed Chairman Jay Powell begins speaking. We have Sherrod Brown right now speaking. He is the chairman of that committee. Let's go to Ira Jersey, Chief U.S. Interest Rate Strategist for Bloomberg Intelligence. Ira, we got some headlines crossing kind of the Bloomberg terminal. Still focused on inflation. Fed Chairman Powell saying making some progress, but we're going to be continuing to monitor it. What do you think we're going to hear today?
Yeah, so the prepared remarks were unremarkable, basically in line with what the minutes were.
I thought they were well written.
Week.
I don't know.
Yeah. I'm not saying they weren't well written. They just
Okay.
weren't, and it wasn't anything really new,
All right,
in it,
I got
right? So I think it's interesting that he did reiterate when he starts talking about monetary policy in the remarks that that they are meeting by meeting. So basically he's saying and reiterating that they're as data dependent as they can be. So if we wind up getting a slowing in the economy, a worse job market, and slower inflation over the next couple of months, then September is in play. And certainly the minutes made it sound like September is potentially in play. There's still a big risk of September, I think, just from an independent standpoint, because if the Fed goes in September, the narrative from those people who don't like the Fed is going to be, oh, they're trying to help the Democrats win the election, blah, blah, blah. So that's not something that Jay Powell will ever talk about or ever admit, but that has to be in the back of their minds at some level, is what are the knock-on political implications if we do this. Then again, if we see job losses in August, for example, then a cut would, they could easily make the case for a cut in September, but we're not there yet, right? Most of the data is slowing, but it's not slow, and that's something else Jay Powell mentioned in his remarks.
Yeah, I found that interesting, and I wonder if the balance is now shifting to worries about growth versus worried about inflation. Like if you think of that as a barometer or like a scale? Where do you think we are in that?
Well, I think that's right, but at the same time, the economy is a system. So slower growth usually begets slower inflation, right? And that's kind of what the Fed is hoping for. What they really just don't want is to fall into a recession. So the lines that you've heard from the Fed, almost every Fed speaker, and certainly the chair, and in today's remarks, they'll say this again, is that they don't want to cut too soon because they're worried about a reacceleration of inflation, but they don't want to cut too late, right? So they're looking for this Goldilocks kind of scenario. And the trick is that they don't know ex ante, right? Because every move that they make in terms of cutting has to be, okay, meeting to meeting based on what the incoming data is, but it's not really the incoming data, it's more the extrapolation and the forecast then of what the next few data points are going to be and how bad the economy can get or how good the economy can stay. That's going to have to drive their policy decisions.
So, Ira, I mean, just looking at some of the red headlines for Bloomberg and Chairman Powell saying easing too little or too late could unduly weaken the economy. Where do you think the Fed is on that risk right here? Because there's a lot of folks, as you well know, that are saying we're actually past that point.
Well, it's interesting because there's a lot of people, including our own Bloomberg economics team, who are thinking that we actually are in the early throes of a recession. But a lot of the hard data doesn't show that. And actually, a lot of the investors that I speak with are saying just the opposite. They're worried that inflation is still too high. They look at the largest 8 stocks being some ridiculous, valuation and metrics, and also note that spending in a lot of categories continues to be reasonably robust, even though there's definitely slowing in some sectors like durable goods. So it's not obvious to me that the Fed has to cut early, but at the same time, I do think that once they cut, their modus operandi is to continue to cut and not like skip a meeting or only cut twice and then wait. They're going to cut 4, 5, 6 times, then wait. And see what's going to happen in the future. So I think they have this tricky balance that they're trying to run. I think ultimately they might not actually start cutting till November, but once they do, they'll cut faster than what the market's currently priced for, and that has some implications for, say, 2-year yields, which might fall further.
So, and you've been saying that for quite a while, and that's very different than, say, what the ECB is doing, which is cut and then wait and see what happens. We're currently waiting for Fed Chair Jay Powell to speak at the Senate Banking Committee. The ranking member, Senator Tim Scott, is speaking now. Then we'll get to his statement, Powell's statement, and then we'll get to the Q&A. Ira, on that point then, is a steepener then a de facto? It just matters. It's going to be more about the steepener, meaning that you're going to have a sell-off, or a lot of buying in the front end.
Yeah, I think, and that's ultimately coming, but it might not really start in earnest until the Fed actually starts to cut, because it's what's called a negative carry trade. So if you're a levered investor,
jargon
you
alert.
buy
Ding.
if you buy 2-year notes and then you fund them via repo, that's negative 75 basis points right now, or thereabouts. So the problem is that holding on to that trade is very costly unless it's working. So I suspect that it will work, but it's a matter of when it will work, and that probably won't be until right at the time that the Fed actually starts to cut rates. What
are traders you're talking to? What are they saying, Ira? I mean, are they positioning themselves anyway at this point, or is it just too early?
Most investors that I speak with are like cautiously long, so they're cautiously long duration, and meaning that they will benefit when interest rates go down. So, which is one of the reasons why you still see the yield curve as inverted as it is. 2s, 10s being negative 35 basis points or so is just a signal that people are long that 10-year, 30-year part of the yield curve. And the reason for that is that they think that in a few years interest rates are going to be lower than they are today. So I have to buy now. And our forecast continues to be we're going to wind up seeing sub 4%, 3.8%-ish 10-year yield by the end of this year. So and I think that unfortunately is becoming more of the consensus. So I think we were reasonably early in that call, and now of course it's consensus, so we have to reevaluate. But I do expect as time goes on, we will get a slower economy. The Fed will be cutting, and that means the entire yield curve will wind up seeing lower interest rates. But to Alex's point before, it's the 2-year where you're going to see probably the biggest yield move overall.
If you were a senator, as we all obviously wish to be, what would you ask Powell right now when your constituents are worried about inflation, et cetera? They're also worried about growth. Like, what would be the question you really want to have answered today?
Well, unfortunately, the question that a lot of people are going to ask, and certainly the one that I would probably ask, Jay Powell won't answer. He'll give a non-answer answer to it. But it's what does he think the relationship is? And what I'm very curious about is what does he think the relationship is today between interest rates and the economy? Because I think that has changed very significantly over the last 30 years. There's just a lot of structural differences in the economy today than it was in the 1980s or 90s, when monetary policy clearly had a pretty big effect on the economy, and that while the long and variable lags were kind of noticeable, right? They were about a year-ish, right, plus or minus a few months. Today, though, those lags might be far longer and might actually be different. You listen to folks like Rick Reeder at BlackRock, and he's saying that, hey, high interest rates actually are supporting the economy as opposing to slow it. And I'm sympathetic to that, because when we look at the money markets and just how much cash flow is being thrown off by money market mutual funds today, and the extra $6 trillion that are in that market right now, that is a non-trivial amount of money that people can either spend or makes them feel more wealthy, right? So the wealth effect is having an effect there too. So that's something that I think could be asked, and maybe something that Jay Powell needs to answer at future statements.
How is there consensus on the Fed here for interest rate policy? And if not, do I care?
The only consensus that I have is that they will lower interest rates at some point in the future. There is not as much consensus as to exactly when and how. Now, you can look at the economists' consensus forecast, which are saying September, but when you look at the market, the market actually is not convinced that there's 100% chance of a cut in the options market until December. So you're looking at, yes, lower interest rates. Timing is less important to me than the terminal rate. So what happens to, say, expectations for rates in 2025 and 2026? That's going to affect the Treasury market much more than if they start in September or November. That in reality, that doesn't matter to the 10-year as much as it would for, say, the 2-year, or if you're trading short-term interest rate futures.
Do you feel like the Fed has an idea of where the neutral rate is? I feel like they slough off a lot of the questions about R-star.
Yeah, well, ex ante, it's very difficult to really know where the neutral rate is. They have to have some semblance of an idea in their own framework as to, is R-star 2.5%, which is what they put in the dots for the long-term interest rate. But in reality, it's probably, some people I think on the Federal Open Market Committee think it's higher than that, right? It might be 3 or 3.5%, which makes their job slightly easier, because the risk is that if you're trying to stimulate the economy, you have to cut interest rates so you're below R-star, right? And so if R-star is 2.5%, then that means you have to cut to 1% or 2 or 1.5% to be stimulative. Whereas if R-star is, say, 3.5%, then you can cut to 2.5% and be stimulative. And I think that's the challenge that both the Fed has in trying to determine that. But again, like you don't know. And as I mentioned, my view personally, is that the structure of the economy has shifted enough, and we haven't kind of gotten the academic literature and maybe some of the monetary policy framework in order to actually know how monetary policy and our
Hey, Q, use that link I just sent you.
Needs to be in order to have inflation stable and the economy in general growing at a slow but not overheated pace.
Proposal of Basel III Endgame. Give the stakeholders an opportunity to take a look at it and then recalibrate what is necessary. Home buyers, small business owners need and deserve access to credit. Therefore, I'll repeat it one more time. You need to restore confidence in this rulemaking process, pull the existing proposal, and have a complete restart. And then, when the data has been analyzed and is available for the public scrutiny, reissue an appropriate proposed rule following the requirements of the APA. I look forward to your opening statement and having a chance to have a conversation afterwards.
Thanks, Senator Scott. Mr. Chair, welcome. Thank you for your service and for your testimony today. Please proceed.
Shout out
Chairman
Powell,
Brown,
man.
Ranking Member Scott, and other members of the committee, I appreciate the opportunity to present the Federal Reserve's semi-annual monetary policy report. The Federal Reserve remains squarely focused on our dual mandate to promote maximum employment and stable prices for the benefit of the American people. Over the past 2 years, the economy has made considerable progress toward the Fed's 2% inflation goal, and labor market conditions have cooled while remaining strong. Reflecting these developments, the risks to achieving our employment and inflation goals are coming into better balance. I will review the current economic situation before turning to monetary policy. Recent indicators suggest that the U.S. economy continues to expand at a solid pace. Gross domestic product growth appears to have moderated in the first half of this year, following impressive strength in the second half of last year. Private domestic demand remains robust, however, with slower but still solid increases in consumer spending. We have also seen moderate growth in capital spending and a pickup in residential investment so far this year. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In the labor market, a broad set of indicators suggests that conditions have returned to about where they stood on the eve of the pandemic, strong but not overheated. The unemployment rate has moved higher, but was still at a low level of 4.1% in June. Payroll gains averaged 222,000 per month in the first half of the year. Strong job creation over the past couple of years has been accompanied by an increase in the supply of workers, reflecting increases in labor force participation among individuals aged 25 to 54, so-called workers in their prime working years, and a strong pace of immigration. As a result, the jobs to workers gap is well down from its peak and now stands just a bit above its 2019 pre-pandemic level. Nominal wage growth has eased over the past year. The strong labor market has helped narrow long-standing disparities in employment and earnings across demographic groups. Inflation has eased notably over the past couple of years, but remains above the Federal Open Market Committee's longer-run goal of 2%. Total personal consumption expenditures prices rose 2.6% over the 12 months ending in May. Core PCE prices, which exclude the volatile food and energy categories, also increased 2.6%. After a lack of progress toward our 2% inflation objective in the early part of this year, the most recent monthly readings have shown modest further progress. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. In support of these goals, the committee has maintained the target range for the federal funds rate at 5.25% to 5.5% since last July, after having tightened the stance of monetary policy significantly over the previous year and a half. We've also continued to reduce our securities holdings. At our May meeting, we decided to slow the pace of balance sheet runoff starting in June, consistent with the plans released previously. A restrictive monetary policy stance is helping to bring demand and supply conditions into better balance and to put downward pressure on inflation. The committee has stated that we do not expect it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. Incoming data for the first quarter of this year did not support such greater confidence. The most recent inflation readings, however, have shown some modest further progress, and more good data would strengthen our confidence that inflation is moving sustainably toward 2%. We continue to make decisions meeting by meeting. We know that reducing policy restraint too soon or too much could stall or even reverse the progress that we've seen on inflation. At the same time, in light of the progress we've made both in lowering inflation and in cooling the labor market over the past 2 years, elevated inflation is not the only risk we face. Reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering adjustments to the target range for the federal funds rate, the committee will continue its practice of carefully assessing incoming data and their implications for the evolving outlook, the balance of risks, and the appropriate path of monetary policy.
I wonder if the senators are really listening to what he's saying, or if they're just kind of preparing their questions and trying to decide what they want to get out of him after his opening statement.
We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to achieving maximum employment and stable prices over the long run. Our success in delivering on those goals matters to all Americans. I'll conclude by emphasizing that we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. Thank you. I look forward to your questions.
Thank you, Mr. Chair. And the senior member of the committee will begin the questioning. Senator Reid.
Thank you very much, Mr. Chairman. Former President Trump has indicated that he would propose, if elected, a substantial increase in tariffs of between 10 and 60%. And by doing thus, eliminate the federal income tax. First, on the question of what would be the impact of tariff increases on prices, consumers, and the economy?
Thank you, Senator Reid. So I'm going to say that we go very far out of our way not to comment on campaign type information. We just don't do that. We also don't comment on trade policy. We have really specific and important jobs, and we try to stick to those.
Well, I'm glad I allowed you to establish that principle up front, Mr. Chairman. But let me opine a bit. 10% increases in tariffs is going to have an effect on prices in the shop aisle. It's going to increase them because that's unlikely. 60% tariff increases are significant. And in fact, I've been told that to replace the income tax, you would have to raise tariffs across the board 70% to make up for the loss of the income tax, which would, I think, create huge economic problems. I respect your impartiality and your neutrality, but the numbers don't seem to add up to anything that would help the country. Let me switch to something else that might be more within your line of response. You said in your opening statement that labor markets appear to be in a better balance. And that's one of the key factors to judge whether interest rates can be raised. I must say I'm concerned a bit that we're not on a very faster track to decreasing interest rates from the Fed. And because of the better balance you cite. Could you comment on that, Mr. Chairman?
Sure. So the most recent labor market data do send, to your point, a pretty clear signal that labor market conditions have cooled considerably compared to where they were 2 years ago. This is no longer an overheated economy. This is an economy, as I mentioned in my opening remarks, that is more or less back by most measures to where it was before the pandemic. And that was a strong labor market, but it was not an overheated labor market. So I think the upshot of that really is that we're well aware that we now face two-sided risks and have for some time. But now the labor market appears to be fully back in balance. We know that if we move too quickly, we risk unnecessarily hampering economic activity and possibly interfering with the ongoing expansion. We know that if we move too slowly, that we may undo the good we've done. Well, actually, it's the other way. If we loosen policy too late or too little, we could hurt economic activity. If we loosen policy too much or too soon, then we could undermine the progress on inflation. So we're very much balancing those two risks, and that's really the essence of what we're thinking about these days.
But the direction seems to be going towards lowering interest rates at some point, we would hope. That might be a wish rather than a direction.
But I think if you look at the last summary of economic projections, I guess I would say it this way. It doesn't seem likely that the next policy move would be a rate increase. We don't take things like that off the table, but that does not seem the likely direction. The likely direction does seem to be as we make more progress in inflation and as the labor market remains strong, we begin to loosen policy at the right moment.
Thank you. Just 2 weeks ago, the Supreme Court handed down 2 decisions that impact every federal regulatory agency, including the Federal Reserve. They overturned the Chevron case, which had eliminated judicial deference to agency decision-making for many, many decades. And they also dramatically extended the statute of limitations under the Administrative Procedure Act. What is your judgment is the cumulative effect of these decisions on the Federal Reserve more broadly, what does it mean to the economy if virtually any regulatory decision the Fed makes can be second-guessed by a judge? What position are we in now?
So we're as an institution very focused on reading the actual letter and intent of the law and following it carefully. This is a strong institutional value that we have. Those are brand new decisions that just came down, and we're really in the process of just studying some. I don't have anything for you on them, but we will of course follow the law as the Supreme Court. As the Supreme Court
All
has
right, fellas,
read it,
I'm gonna
because
hop
that's
off
their
here.
job.
Well, thank you.
All right,
I concur with
See you
compliance
guys later.
Watch this for another 10 minutes or
when you
so.
do your analysis,
Yeah.
and if it
See you
is
both.
detrimental to your ability to regulate the banking industry in the United States, I think you have an obligation to make that public. Thank you, Mr. Chairman.
Thank you, Senator Reed. Senator Scott from South Carolina is recognized.
Thank you, Mr. Chairman. Chair Powell, we've heard a steady stream
Edward,
of
get out of there
commentary
right
that
after
there
you
will
answer
be changes
Kenneth's
to Basel III
questions.
endgame proposal. That
Yeah,
can be seen certainly
that's funny.
as good news. Some reports say it could be finalized as soon as August. Others say you're circulating a term sheet for a revised proposal. Through it all, this proposal will have outsized impacts on our banking system, from big to regional to our U.S.-based foreign institutions, as well as impeding access to credit for consumers. So even though you yourself have said there will be broad and material changes, I believe this proposal is flawed, both in process and in substance, and should be withdrawn. Do you agree, and will you commit to withdrawing the existing proposal and issuing a new proposal with a robust notice and comment process?
Well, let me update everyone on the status of all that. So over the past several months, we've had, in fact, Vice Chair for Supervision Barr has held a series of discussions with the other bank regulatory agencies around potential changes to the original proposal. I'm pleased to say that we've made quite a bit of progress on those and are very close to agreeing on the substance of those changes. And I can't really be specific because nothing is agreed until everything's agreed, so I won't have a lot of specifics for you today. The question where we're continuing to try to make progress is that of process. So it is my view, it is the strongly held view of members of the board that we do need to put a revised proposal out for comment for some period. And the reason is, when there are broad and material changes, that has been our practice. We don't see a reason to deviate from that practice. It seems to be consistent with past practice and with the Administrative Procedure Act. So that's very much what we think. And we're working through that question with the FDIC and the OCC. We haven't reached agreement on that, but I'm very hopeful that we will. We're prepared to move forward when we do reach agreement on that.
Well, I appreciate most of your response there. I do want to discuss one aspect more of Basel before we move on to another topic. I find it very concerning with how much of this proposal, this process, appears to have been done behind closed doors. The Fed, the FDIC, OCC proposed Basel III endgame last July. Then in October, the Fed began the collection of data to conduct a quantitative impact study on the cost of Basel III proposal, a study which I will note should have been conducted before any proposal was ever issued. Move forward to January of this year, Vice Chair Barr committed to a public comment period once results of the study were published. We are still waiting to view the results. Keep in mind, all the while, we're hearing rumors that the Fed is working on revising its proposal and moving towards an updated version. Please help me understand, how will the Fed revise or reissue a capital proposal before receiving public comments? Basically my question.
Well, as you know, we have received extensive public comments, and we've also evaluated the quantitative impact survey that you mentioned.
Yes.
And so the idea would be when we do reach agreement with the other agencies fully, that we would publish the proposed changes and also the quantitative impact survey, and also the effects that the QIS suggests that the changes would have. So we'll put all that out for comment again for a period of time, and then having had yet another round of comment, and we can then move toward finalizing. That's basically the broad strokes of how I would see this moving forward.
And how long do you see that opportunity for public comments?
So it would be meaningful. I mean, it might be 60 days. We don't need to make, it doesn't need to be a long one. But, you know, before we do that, there's a lot of work that needs to take place, you know, before you actually put out the revised proposal. Quite a bit of work. So it will take some time, and then we would put it out, and then it would be, I'm just taking that number, 60 days of comment, and then we would get the comments back, and there would be another period of evaluating the comments, and only then would you go final. So there are a number of steps here.
Yeah, thank you. Well, just final point as I'm running out of time here. I think Senator Reid made the comment about the Chevron.
I'm running bearish. I'm running bearish on the dollar more and more as I hear
the regulatory state. The necessity of a cost-benefit analysis on new regulations that
or
dovish, I guess,
is the term.
The thousand plus pages of Basel III, I think there were about 20 pages that reflected some kind of cost-benefit analysis approach. I really hope that we see more of that going forward.
Thank you.
Senator Tester from Montana is recognized.
Well, thank you, Mr. Chairman. Thank you for the courtesy. Chairman Powell, good to see you here today. Appreciate your work. Look,
it's crazy all the different, like,
regardless where I go in the state of Montana,
perspectives
housing is a
and
big issue, whether it's Billings or
opinions that these people asking questions have. You can just tell in their question.
Larger towns to medium-sized towns to small towns, housing is a huge issue. And I think it's a huge issue all over the country, and correct me if I'm not correct in that. And I was wondering how the housing challenges fit into the overall economic picture that you're seeing.
So
this response will be key for all of our home sales.
We do pay a lot of attention, and I would agree with you. We have significant housing issues in the country, and we had them before the pandemic. Certainly, the pandemic has created new distortions, and you know, monetary policy works through interest-sensitive spending. There is no more interest-sensitive spending than, you know, buying a house and having a mortgage. So, for sure, our tighter policy is having an effect on economic activity in the housing sector. But I would also say the best thing we can do for housing is to succeed in getting inflation down to 2% on a sustainable basis, so that rates can come down, so that the housing market can get back to what was the pre-pandemic normal, which is to say still a housing shortage, but not dealing with the kinds of specific things we're dealing with now.
So let me drill down a little bit. I'm speaking not necessarily from a housing cost interest, and you're correct on the things you just brought up. I'm speaking more from a standpoint of economic growth, in that there are plenty of small businesses, schools, hospitals, Main Street businesses that can't hire people, they can't expand because there simply is no place for them to live. How does that fit into your economic outlook metrics?
Tough question.
Because I think it's
really important,
from my perspective,
especially for Montana, a place like Montana.
Limiting the opportunity for expansion. It's limiting the opportunity for entrepreneurs, business startups. And does that fit into the economic picture that you look at?
So our mandate is for stable prices and maximum employment. And again, I think for housing supply, the best thing we can do is get inflation under control so that rates can come back down, so that we can have a more normalized set of rates and a more normalized housing system. But I think policies to increase housing supply are really not so much in the hands of the Fed, they're in the hands of legislatures, you know, state and federal.
Do you believe that if we were to put forth some housing incentives, whatever they may be, that could have if those incentives resulted in more affordable workforce housing on the market, that would have positive impacts on the economy?
You know, these are questions for you, but I would say this, that I'm aware that housing is in short supply, and that for many it's a critical need for the workforce. Okay. And so more of it is better. But as to where the fiscal policy how you should prioritize that, that's not up to us.
Look, I want to talk about the independence of the Fed for a second, because I know that you are a strong supporter of independence, as am I, and political influence I don't think helps with monetary policy in the country. And so give me give me your perspective at least on why the central bank independence is so critically important.
Thank you. I'd be glad to. So essentially all advanced economies have adopted a policy of central bank and operational independence. And that just means that we make our decisions, we're instructed to make them without taking in extraneous factors, one of which would be politics. And the record is pretty clear that that's a good it's a good institutional arrangement that serves the public well. And we just want to stress, as we do periodically, that this is an institutional choice that we make as a country, and that as long as it's seen to serve the public well, it's a good choice. We think so.
Okay, on advanced economies, there's some that talk about the economy of this country not being in very good shape. From your perspective, tell me how the economy of this country is doing compared to other advanced economies that have central banks.
So I'm in lots and lots of international discussions as part of my job, and the story for the last 2 years has been just how exceptional the performance of the U.S. economy has been, and that's not a secret. Clearly the U.S. economy has performed very well compared to sort of our advanced economy colleagues.
Is there any country in the world with a central bank, any advanced economy that's performing better?
Better as a central bank?
No, any economy that's an advanced economy that has a central bank that performs better than us?
None comes to mind. As I think of the majors, the answer would be no.
Okay, thank you.
Thanks, Senator Tester. Senator Rounds of South Dakota's
Wonder
recognized.
what that
Thank you,
does
Mr.
to the
Chairman.
other major currencies,
Chairman,
the
first of all,
euro
thanks for coming in
against the
and visiting
US
with us.
dollar and stuff like that.
I just want to focus on two specific items, and I'm going to start with the Basel III endgame discussion. I think Senator Scott did an excellent job of kind of laying out the concerns that many of us have had with it. I would like to go back into just one particular issue, which I think a lot of folks out there that follow this, and I know it's technical in nature, but let me just ask a specific question, and you can kind of pick it apart for me, please. Both you and Vice Chair Barr have confirmed that there will be material changes to every risk type outlined in the proposal. Since there will be significant changes, do you believe where the agencies have landed now would be considered a logical outgrowth of the original proposal from last summer?
For those people who are not familiar with, that's the legal test for that turns out to be if it's a logical outgrowth. If it's not a logical outgrowth, that would legally require a reproposal. And I don't want to make the legal judgment. I will just say again, from my standpoint, my view and strongly held view of some of my colleagues on the board is that it will be appropriate for us to put out the changes again for a period of comment, just because it's the right thing to do. It's what we would do typically in a situation where there are, material changes to a proposed rule.
Do you feel that you have a consensus on the board to allow that to move forward in terms of an additional comment period?
Yes, but of course we have to get the FDIC and the OCC. We're in discussions with them to work on something that would meet that need, and we have to get their agreement too.
Assuming it sounds like that's the path that you would like to go down.
Yes.
If that were the case, would it be fair to say that we'd probably be looking at final determinations or recommendations for a Basel III endgame proposal probably into next year before it would become anything of a final determination? I
think that may be right. It's that's something like that could be right. Yeah. I mean, it's hard to be precise. We would put it out. It takes some time to write this stuff up. Then you put it out for comment. Then you get the comments. Then you read the comments. Then you write the final rule. Beginning part of next year is a good guesstimate.
The only reason why I push is because there are so many folks directly involved with this and the impact on our economy here and with a lot of our financial institutions. This is a significant change, and it's one that a lot of people are following. So I'm trying to get you to get into the depth of this as much as possible, and I thank you for that. I'd also want to go into one other area, and once again, this is something that you and I have had visits about in front of this group before, but I want to talk about what the parts of inflation are and what parts you can control and what parts, as the Fed, you really can't control. The demand side of the equation on inflation is the part that you have the tools to work with. But there is the supply side of the equation, which is still out there. And I want to just lay this out because as we do this in this setting, it naturally becomes political in nature because one of the starting points that we talk about is when this administration took office and what happens with supply side issues at that time. And as I work my way through this, I just want to share the concern that I've got. And then I recognize you don't want to be political in it, but I want to lay this out. And then I want to talk about what you can control and what you can't control with regard to making changes on inflation through the processes that you have. When President Biden took office, gasoline prices, since President Biden took office, gasoline prices have risen over 54%. Energy prices have risen 41%. Fuel oil prices have risen 37%. Now, I can go on, but you understand what I'm saying is that energy has increased substantially. And I think one of the reasons for this has been additional demand as we've come out of a pandemic. But the other part of this has been whether or not investors really want to go back in and invest in traditional energy resources after the president made the specific determination to cancel the Keystone XL pipeline on the day that he stepped into office. When he did that, he sent one heck of a message to investors about traditional energy and investing in traditional energy in the United States, and the fact that a multi-billion-dollar contract or contract could be canceled with the stroke of a pen. Now, my question to you is, what percent, or has there been a discussion about what percent or what amount of the inflation that we've seen, over 20% increase in terms of affordability for a lot of our products, how much of that is attributable to the demand side and how much of it really is attributable to supply side challenges that we've seen in this country?
That's a question that we've thought about a lot, and any attempt to reduce that to a precise number would be inappropriate because it's so uncertain. But I think we can say, I believe strongly, there's a significant demand element and there's a significant supply element. And we've seen the supply side heal so much over the course of the last year or so, and we clearly see that that's contributing to lower inflation. We also see cooling demand, for example, in the labor market. So the two forces are working together. I can't really break it down. It would be such an imprecise estimate.
Just simply an acknowledgement, though, that it is both demand.
It's both. It's definitely
and
both.
it is supply.
It is both. Yeah, for sure.
Thank you, Mr. Chairman. My time has expired.
Chair Powell, unemployment has risen by 0.5 percentage point over the past year. The number of job openings has dropped almost 50%. The hiring and quit rates are now below pre-pandemic levels. I'm concerned that if the Fed waits too long to lower rates, the Fed could undo the progress we've made on creating good paying jobs. Full employment is part of the mandate, as you say over and over. How are you assessing the risks of higher interest rates in the labor market?
So I completely agree with your characterization. The latest data do show that we've had considerable cooling in the labor market, and we're very much aware that we have two-sided risks now, as I mentioned earlier, and we're determined to balance those as best we can. We want to see more good inflation data, and we also want to continue to see a strong labor market. And those two things are equal under the law. We have this challenging thing to balance them, but we're very much conscious that that is our job, and we're trying to do that.
Well, and you know that if unemployment trends upward, you must act immediately to protect Americans' jobs. Workers have too much to lose if the Fed overshoots inflation target and causes a completely unnecessary recession. We will say that over and over and over again. I think you understand that. Housing, higher interest rates are making housing more unaffordable. Higher rates are supposed to lower cost, yet housing prices continue to soar. By keeping rates high, the Fed ignores the economic reality of the millions of Americans struggling to make ends meet and get ahead. Let me ask you 3 quick yes or no questions, if you would answer that way. Since late 2022, when the Fed began raising rates, has the volume of housing sales decreased?
I believe it has, yes.
Since late 2022, has the median home price increased?
I believe it has.
Since late 2022, have monthly mortgage payments become more affordable or less affordable for home buyers?
Less affordable.
Okay, thank you. In short, despite housing sales declining, the median price for a single-family home has increased by nearly $20,000. People are spending a greater share of their income and mortgage payments. So in sum, higher rates It's clear from your answers and data, it's clear higher rates are not bringing down housing costs. The cost of home ownership is only going up. Let me shift to the Synops bankruptcy. Since mid-May, tens of thousands of people, including many Ohioans, have lost access to their money due to the bankruptcy of this fintech middleman. Reports indicate that as much as $95 million may have gone missing. The Fed oversees one of Synops's former partner banks, Evolve Bank and Trust. As a regulator, it's your job to make sure that banks protect the people whom they serve. What's the Fed doing to help customers who felt the impact by the Synops collapse? What are you doing to regain access to their money?
So we do supervise the bank. We don't supervise Synapse, or let alone the fintechs that feed into Synapse. And we're strongly encouraging Evolve to do whatever it can to help make money available to those depositors. We also, as you may know, did an enforcement action against, before this all happened, we did an inspection or looked at Evolve, and we hit them with an enforcement action around these very risk management issues, again, before the current situation developed.
Okay, it's critical that consumers are made whole as soon as possible. We will continue to talk to you about that. We will watch. We will let you know we're watching. The Fed needs to use its supervisory authority to ensure that Evolve is committing the resources necessary to return those funds to the account holders. Last comment, I want to note one last thing. Last year's Fed report on the failure of Silicon Valley Bank noted how incentive-based compensation encouraged excessive risk-taking that led to the bank's failure. You either watched or had reports of when those bank CEOs testified in front of this committee. The report, the incentive-based compensation that led to the bank's failure, I mentioned, it said that SVB managers, quote, had a financial incentive to focus on short-term profit over sound risk management. That's what a number of us, Senator Smith, Senator Butler, Senator Warner and I have said over and over, that short-term profit over sound risk management causes significant problems to our financial system. Compensation practices still pose a threat to our banking system. I urge you to move quickly to join your colleagues in the long overdue rulemaking on executive compensation. I mean, you read the reports at the outrage of the public about executive compensation continuing to go up and up and up and up. You have a role, a significant role, a legal role to deal with that. Thank you. Senator Tillis is recognized.
Thank you, Mr. Chairman, thank you for being here. I want to be real quick on Basel III Endgame, and I want to be mindful of time. Just simply, can I get a commitment from you on releasing the results of the QIS?
Yeah, we plan to release the results of the QIS.
What time frame?
Well, first we have to get agreement with the other banking agencies, but as soon as possible.
Can you imagine any agencies having a concern with any other banking agencies having a concern with releasing it, or is it just a matter of pro forma? Okay.
It's just a matter of the bigger picture of getting agreement on the revisions to Basel III and also how to proceed.
That's great, and I really appreciate the feedback that I've received from you. I should have started by thanking you again for your continued accessibility and discussions outside of the committee. They're very productive, and I appreciate that and your leadership at the Fed. I grew up in the 70s. Got my Social Security number in 1973 when I was 12 years old. That's when I made my first payment. So I've been following the economy even as a youngster. And that was a really lousy time to enter in the workforce. Tell me, and I'm hearing discussions among some of our members now that would almost be reminiscent of discussions with prior Fed members saying, look, we got to lower interest rates and we've got unemployment out of control. So it sounds like we're taking some suggestions from some of my colleagues or plays from a playbook that didn't prove to be very effective back in the 70s. What can we learn? I'm not going to ask you about where you go from here, but if we look back into a post-mortem on some of the decisions that were made when we had consistently high inflation, we had consistently high unemployment, what lessons can we learn there, or what mistakes should we not necessarily repeat? And I know that this is a fingerprint of a challenge. It's not exactly like the stressors that we had back in the 70s, but what can we learn from the decisions of what I think are arguably the wrong decisions made back then when we were dealing with high unemployment and high inflation? What did we learn?
I think the number one thing we learned was that it's up to the central bank to take it on and stick with it until it's done. And that doesn't sound controversial now, but it actually was back then. And so people didn't really get in there and get it done, and inflation kept coming back. I also think there were significant differences this time to the questions a minute ago. This is a combination of a supply side that we had very significant supply shocks along with big demand shocks from the reopening of the economy and from all the other things that happened. So I think we have to, each one of these things is different in its own way. We try to learn the lessons of history, though.
Do you agree or disagree? Any disconnect between inflation and inflation expectations from the 2% target should be addressed now and not at a later time?
Absolutely.
I like that answer. I want to go to something different. I'm trying to go into a lightning round now and finish on time. We've seen the 2024 stress test results for the banking, U.S. banking system. It looks like to me, by every objective measure, we've got a banking system that's on strong financial footing. Do you agree?
Yes.
One last thing is the Fed considers making broad and material changes to the Basel III proposal. Back on that one. Can I urge you not to overlook the second order issues important to FBOs and certain regionals to ensure the banks are not unduly influenced? If the current proposal, for example, the outsized operational risk costs were high, are we going to take care of that in any sort of reproposal?
Let me just say we're very conscious of the comments across the spectrum: foreign banks, domestic banks, small, medium-sized banks. You know, everyone's going to get heard carefully as part of this process. That is our obligation.
Okay. And I think in response to Senator Round's question, you did indicate that probably because of the nature of the likely changes from what Mr. Barr expected to what may ultimately come, we are going to open it up to comment again.
That's the strong view of the Federal Reserve. We're working on that question with the FDIC and the OCC to try to find a path to do that. But
Very good.
From our standpoint, that's essential.
I think it's a strong view from at least several members on this side of the dais here. That would be very, very important because I think it's going to materially change. Thank you, Mr. Chair.
Thanks, Senator Tillis. Senator Warner of Virginia is recognized.
Thank you, Mr. Chairman. Chairman Powell, it's good to see you again. Coming this late in the questioning, I'm going to at least hit a couple of the items that my colleagues have otherwise already hit, because I'll make sure it's noted that I raised them as well. First of all, I want to agree with the chairman. You know, I probably hear more on housing and housing affordability than any other issue, and I agree with the chairman. And I know we've discussed this around a rate cut, and I understand most of your answer, but I still want to add my 2 cents here. We've got to find a way to start bringing mortgage rates down and let people get unlock that housing market. And again, we've discussed the rate cut issue, and I know you've got to navigate that, but I hope it's sooner than later. I will not recap what I've done in the last couple hearings with you, but I do think the discount window proposal that I've gotten, that I know you're working on, you know, before we think about additional regulations, and we do need in some cases, I think the discount window is an underused tool. Was one of the original tools for the Fed. A lot of my colleagues have talked about quantitative easing, Basel III endgame. I do hope when we get the revisions that we'll see the quantitative analysis that, again, Senator Tillis already raised and other colleagues have raised. I also hope that one of the questions I raised in my March letter to you was, you know, making sure any new regulatory structure, how it intersects with existing regulatory structure and terms of market risk, credit risk, and I, again, hope that we will have that as the revisions come out. I think one of the things that this debate around Basel III raised was that it is, my understanding at least, looked at, you may be all looking at revisions to liquidity standards as well, and wanted to see what you could say about that and whether that part of those standards are under review and what your thinking is.
Yeah, and I think that actually connects to the Silicon Valley Bank questions as well, where I think there seems to be a need to update assumptions about liquidity, and that's a separate proposal that we're also working on, and very important. I think we saw how fast that run was. It was just exponentially faster than prior runs. That's the new world, and that's some estimate of what that world is baked into things like the liquidity coverage ratio, for example.
Right, and wasn't that the case, if you had 25 cents on every depository dollar leave in 6 hours, no matter what the capital standards are?
Yeah.
And one of the things, I guess, there was a lot of talk after SVB that we need to think about internet-driven runs. A lot of us raised concerns. Candidly, I'm not sure I've heard any good proposals. So whether it comes from you guys or from folks listening, how we think about this new internet-driven world. And frankly, I think some of the irresponsible behavior by some of the folks that were major depositors in SVB who in many ways shouted fire in the crowded theater, and we've not seen any action there. So I would welcome additional ideas as well. And that kind of brings me to my last questions around supervisory reform. I know the GAO criticized the Fed's supervisory procedures in the role they played in the 2023 failures. It is a whole brand new world. Are we going to look at, will your changes to supervisory standards be comprehensive? Will they be one-off? How do you think about that in light of the GAO report and also in light of just the SVB and a few of the other failures we saw last year?
Vice Chair Barr is, who's Vice Chair for Supervision, is leading a process of looking at the way we supervise banks and thinking about how we can be faster where it's appropriate, more forceful where it's appropriate. And I think, they've taken a pretty deep dive and tried to learn these lessons and then implement them in a way that is appropriate. So that's a big project going on at the Fed right now, which really Vice Chair for Supervision leads.
I think I remember lots of conversations with the chairman, with you, with the FDIC, and that Thursday through Sunday. And I think the solution you guys came up with, the administration came up with by Sunday night was a good one, but they were a pretty scary 3 or 4 days there. And it did seem like the process, I don't know completely how you get fully ahead of that. But I firmly believe that there should have been a clearer early warning system and trying to make sure that we wouldn't be in that kind of crisis situation going forward. And again, I would strongly encourage any additional thoughts on this technology risk and how we get that right. Thank you, Mr. Chairman.
Thank you, Senator Warner. Senator Kennedy of Louisiana is recognized.
All right, Marcus, I'm gonna slide off here.
Mr. Chairman,
I'm going to later today before I work. I'm gonna get a bunch of application stuff done early over the next couple hours. Hit the gym. Then I'm gonna review the transcript of this. I'm sure the transcript will be available, and kind of just do some research as far as the insights and the takeaway, in terms of our financial tools. But yeah, it's interesting just hearing the different senators' perspectives and what they find important, and how they kind of how Powell's hands are tied in a sense. How not being able to comment or tie anything political to it. It's very interesting. This is the first live stream that I've watched. So it's interesting how they kind of go about, doing their rounds of questioning and Powell's rebuttals and returns to him, because it's very subtle. And I bring up how he doesn't want to talk anything political. I bring that up because his answers are very subtle, and it really is just it's the verbiage and the subtle things, subtle words that he uses that really gives us the insight as far as what's really going on. But yeah, no, it's super interesting. Super interesting.
Super interesting. Let me know when you're gonna do the transcript. Because I'm pretty much home all day, so
Bet.
I'll
All right.
probably I'll probably do that as well.
Sounds good. Sounds good. All right, man.
All right, my boy.
Yes, sir. Yes, sir. End of the live.
End of the live. See you guys tomorrow.